Good afternoon, everyone. I'm Stacy Scott, and I'm here with Graham Wickham, President and CEO of Wickham Financial and Insurance Services, and we're back with you today for our weekly wrap-up.
Yep.
Graham, what can you tell us about what's been going on in the market this past week?
All kinds of fun stuff going on in the market last week and this week and next week, right?
Right.
But thank you for the listeners being on the call. Globally, we really saw just a good surge in international equities, kind of spurred on by technology, the optimism that the U.S. will come to a resolution on our debt ceiling negotiations. So we saw, at least in our markets, the NASDAQ up about 3%. We saw the Russell 2000 small cap up about 2%, driven really by regional banks bouncing back about 8% last week. We saw the S&P 500 gain about 1.5%. If we look overseas, and I don't want to give all the story on overseas, but we really saw the German DAX index close at all-time highs, while the Japanese Nikkei 225 didn't remain or maintain its highest level since 1990. We saw 7 of the 11 S&P sectors finish in the positive territory. So what was the biggest gainers? Probably not any surprise to anyone right now. If you've been following the news and all the technology discussions, technology is up about 4%. So we saw artificial intelligence continues to spark the idea that this could be additional revenue streams for companies to continue to buoy and promote higher profitability. U.S. Treasury yields did spike. We saw some economic data showing some surprising resilience. Retail sales returned to growth in April. Again, we saw some steady consumer spending patterns generally across the board, except for big ticket items. They continue to move away from those big ticket items, still focusing a bit more on necessities and experience. We think about home builder sentiment turned positive for the first time since July. Home construction stocks really reached a 16-month high, and U.S. housing starts gained about 2.2% in April as existing inventories still remain pretty tight. Total U.S. households debt did hit a record high of about 17.05 trillion. So that could be a harbinger of maybe they're burning through those cash reserves that they built up through COVID. We'll just have to see how quick, how fast. Could be a harbinger of maybe some issues down the road, but I don't want to put that out there too hard and heavy right now. If we look overseas internationally, we saw China's industrial production retail sales number significantly growing month over month. Expectations for easier monetary policy were still mounting, even though we saw significant growth. It's not growing as fast as expected. So maybe they're going to have to do some things to kind of promote, consumer spending, borrowing, so on and so forth. Japanese Q1 GDP expanded about 1.6%, reversing 2 consecutive quarters of contraction. Now, their core consumer prices rose about 3.4% year over year. Now, let's compare that to the United States. Our core, right, CPI, is about 5.6. They're a good bit lower. Australia's kind of stagnant wage growth and falling employment suggests that maybe their reserve bank has kind of peaked out on their tightening cycle. And we just continue to see real muted growth, maybe stagflation fears starting to bubble up here in the European Commission.
Okay.
Yep.
Well, Graham, with the debt ceiling decision looming, if they don't come to a resolution, how do you think that's going to play out in the markets?
Yeah, I don't think everyone's going to be too happy about it, right? That could be an understatement. But keep in mind, I mean, everyone throws out numbers and expectations, concerns. This can get kicked down the street. 100 different adjustments to the debt ceiling since World War II. The last time that we saw it go past, not kicked right away, was in 2011. And I think the S&P was off, or the markets were off about 17%. I don't know if that's what we're going to see. I know that was a bit short-lived because they came back together and again kicked the can down the street. I'm kind of expecting that. I'm expecting that they'll kick the can down the street, they'll grandstand a bit because what we have elections coming up next year. So everyone wants to, stand strong for their constituents, and I think that's a bit of what we're having right now. So could get some volatility in the market, but what volatility we get, as long as the earnings are holding up and the consumer is holding up, could present some really good buying opportunities if you feel like you've missed out in certain areas.
Okay, well, that's good. All right, thank you so much for that, Graham, and thank you to everyone for joining us today. I do have a couple of reminders that I want to throw out to you. First of all, happy Memorial Day weekend, everybody. It's coming up this weekend, and our office is going to be closed on Monday. Then on Wednesday, we'll be having our monthly lunch and learn. And this month's topic is going to, we're taking the opportunity to answer some questions from our viewers. So if you have any burning questions that you would like for Graham to address, please shoot those over to me via email within the next couple of days, and we'll have him to address those. So it should be really interesting. It could be a mixed bag of information for you. And then move forward about 2 weeks, and we have our annual car show coming up on June 17th, and that's Saturday morning. And we are going to be gathering, and if you have a cool car that you want to bring, we would love to see it. Or if not, just join us and hang out and have a great time. We are accepting donations for Center for Family Resources. So bring your canned goods and non-perishables, and we are going to give back to that great organization. That's it. Have a great weekend this weekend, and we will see you next week.
Take care.